Ken Rosen, chairman of the Fisher Center for Real Estate at UC Berkeley, Haas School of Business, and chairman of the Rosen Consulting Group. Well, the number one thing, of course, is interest rates, and they've gone up dramatically. We think they're all about done in their increase in interest rates, and that's affected the short rate. The 10-year bond also has gone up from up to almost 4.29, and all that means that real estate debt is very expensive and hard to get. We've had a doubling of debt service and a doubling of cap rates, and so this is causing adjustment and problems in the real estate industry. Office buildings in particular, along with work from home, are increasingly unable to cover debt service. And so we're in the second inning of the delinquency foreclosure process, where people are going to sell real estate and have to recognize losses. So we're in the second inning of that. It's going to take 3 to 4 years to fully roll out in the office sector. Other real estate sectors are doing pretty well, but they're also experiencing increased debt service and decrease in values. So this may be the best opportunity to buy real estate below replacement cost we've had since the early 1990s. Office buildings, you can probably buy somewhere between 25 and 75% less than they were selling for 2 or 3 years ago. Other property types, less of an opportunity to buy cheaply, but still below replacement cost. And then wait for the opportunity to refinance at some point in the future. So a lot of people are going to have no choice but to sell or give it back to the banks, and the banks will want to get rid of those assets at somewhat below replacement cost prices. So it's the opportunity to buy cheap, cheaper than they have been, and probably below ultimate long-term value. I think most people are hoping that rates go back down again and everything will be okay. But it's not true. That this is higher rates, higher for longer. This is the new normal, the new paradigm. The old paradigm of cheap money, easy debt, I think is not going to happen for the foreseeable future. So they're thinking it's going to go back the way it was. It isn't. So this is the biggest adjustment the real estate market has faced since the early 1990s. And there's opportunities, but also if your existing portfolio, you have a lot of work to do to have it work in the present environment. For new investments, very interesting time, an exciting time. For existing investments, you have to work through the issues that we're seeing of higher rates, higher debt service.